We believe tonight's FOMC is very likely to be an important moment for Jerome Powell, Fed Chair. Now, the question is, will he pivot on the pivot? So it sounds quite convoluted. It's actually remarkably simple and straightforward. We'll go on to explain that, but more importantly, what it's crystallizing is a narrative which this market is beginning to price in. And as a result, that's likely to present us with some fantastic high probability trades. So let us explain that for you in a little bit more detail. Okay, so hello and welcome. Welcome to our latest urgent market update video for Wednesday, the 1st of May, 2024. Now, the title, as you can see up on screen, is we believe this is an important moment for Jay Powell. And he very aggressively in December decided to adopt a bit of a dovish approach from the Fed with regards to interest rates in the US. Now, what we've seen over the last 3 to 4 months, and we'll have a look at some of the data in just a second, is we're not really in a position, or let's say Jerome Powell is not really in a position for him to start cutting rates. So as a result, it's creating this dynamic in the market, this degree of uncertainty around monetary policy. So the markets have taken what Jay Powell had said and ran with it to a very explosive level. We've seen markets rally to all-time highs. We've seen the everything bubble. We've seen cash piling into all sorts of different areas. Now, Jay Powell needs to take responsibility for what he said in December and in January and February, and realize that the data is not really lining up for him to be able to start cutting rates. So he needs to, if we understand that his initial pivot was regarding cutting rates instead of going from higher for longer to we'll start seeing a series of rate cuts. And now he needs to pivot on that pivot, which is like, actually, the data is coming in a lot stronger than we expected. Inflation is actually ticking higher instead of ticking lower. So we may need to stay higher for longer. As a result, that's likely to present us with some fantastic opportunities, which we'll explain now in just a second. So that's what we'll cover in the next sort of 5 to 10 minutes. If we can start, of course, with our risk warning currently up on screen. Please take a brief moment to familiarize yourself with this risk warning. Now, so let's get straight into it then. So what we want to draw your attention to is this news event here today. And we've got some important job numbers that are due out this afternoon in the build up to the FOMC later on this afternoon. But by a country mile, we're not expecting these news events to drastically impact price prior to the FOMC. So the main focus is on the FOMC. And we're very much expecting the Fed to agree to hold rates of 5.5. I don't think there's any significant change in that respect. We've been up at these elevated levels for 1, 2, 3, 4, 5, 6 meetings already. This is the 7th meeting where we've stayed higher for longer. And like I said, if we go back to December, which was this is the 4th Fed meeting. So 4 meetings ago, we effectively had Jay Powell say, yeah, well, the Fed will very likely cut rates 3 times in 2024. It doesn't really look like that's on the cards. So the expectation for softening interest rates in the US is very, very slowly subsiding and just moving away. And what we're left with is higher rates for longer, which is 5.5. There's some commentators, there's a lot of analysts, and Jamie Dimon as well from JP Morgan is suggesting that actually the Fed may need to push rates even higher, which means a big shock for these financial markets. And today now it's going to be very interesting. And I suppose the question we ask, is he going to pivot on last December's pivot? Because he may very well need to. Now, will he play some sort of verbal gymnastics and really not say an awful lot? that's very likely to be the case. Maybe he doesn't want to derail the whole sort of dovish narrative, but he certainly has to acknowledge, and I think he eased the ground really 2 weeks ago when he said, we don't really have the confidence to start cutting just yet. So what does that mean for this market? This is where the opportunity really presents itself. And we've seen profoundly resilient markets, of course, since the end of October, down at these lows down here. This is the S&P 500, by the way. So we started to see a pretty significant rally as we approached Jerome Powell. It was kind of early December, so it was around these highs in here. And we've seen basically Jay Powell gaslight these markets to a very significant extent when he didn't have to. So that's a kind of a slightly strange position for him to take, considering, you know, you're kind of forecasting inflation to continue to drop. Now, these central bankers are not particularly good at identifying the conditions in which the need to start hiking rates, which is the whole transitory discussion from 2022. They were pretty slow at tapering their $120 billion monthly bond buying program. They were very slow in doing that. So it's just stimulation after stimulation. And for them not to expect any kind of inflation to come and follow is just pretty naive. It's very naive. In fact, they were talking about it being transitory, that it'll just rise a little bit and it'll come back. No, they were significantly wrong in that assertion. And now we find them doing the same. So really gaslighting, strong rally. We were surprised that this rally maintained itself as long as it did, but we did get the indecision start to kick in. And then 3 weeks ago, we did start to see that interest rate narrative, which was pushed to the side for so long, actually come to the fore. Some significant selling. Then last week, we got the bounce. We got some indecision around resistance levels. And yesterday, we saw the first sort of leg to the downside, with furthermore expected with monthly lows sitting around the 49.27 in the S&P 500. So this coincides with the market beginning to price in this understanding that actually the Fed are not really going to cut like they said they would. As a result, that's bad news for equity markets. Not just that, if we look at bond yields, these bond yields are really causing a problem for Jay Powell because they keep rising. So if we look at the 2-year, we've seen an upside move in the equity markets followed by a very significant upside move in the bond yields as well. Now that's really telling. So while equity markets have been rallying, we've also seen risk levels rally in accordance, and certainly the cost of refinancing that debt for the US government is going up and up and up and up and up, increasing deficits, putting pressure on income and expenditure for the US government, and a whole series of other sort of associated problems that come along with that. So this is kind of a counterintuitive position. So we've been asking for the last couple of months, at what point is this market going to actually price in the fundamentals, which is acknowledging that rates need to stay higher for longer, acknowledging that bond markets are telling us something completely different. At what point will that buy everything narrative begin to fizzle out? Well, we anticipate that this time is, broadly speaking, now. And as a result, we are certainly geared up for a bit of short-term selling across these equity markets like we saw yesterday. And we're also geared up for significant selling across the euro dollar and these other dollar pairs. So we're looking for dollar strength. We're looking for a very significant risk-off market condition to kick in. And it's really because of this particular narrative that these markets are beginning to sort of say, hold on a minute, you know, these conditions are beginning to look a little bit more challenging for perhaps the vast majority of the equity markets. Don't forget, we've been experiencing this profound rally, specifically in the S&P and the NASDAQ and the Dow Jones, the major indice markets in the US and abroad, with the DAX and the Nikkei, and they've all sort of seen new highs. So we're seeing economies that are not particularly performing that well actually achieve all-time highs across their equity markets. So, and then all eyes are really focusing on the Fed, because if the Fed start cutting, it does make it easier for other central banks to start cutting. If the Fed stay higher for longer, that presents a problem for central banks like the ECB, like the BOJ, like the Bank of England. So our bias is very much to the downside. All eyes will be on Jerome Powell later on this afternoon, or this evening, should I say. So we're going to get the federal funds rate very much expected to stay at 5.5%. And the FOMC statement will be released at 7, with Jerome Powell at 7:30. And really, the words that he used and the takeaway from these financial markets is likely to be very, very significant, because what we're trying to take advantage of, and this is what I'm going to leave you with, is the shift in narrative from what has been a very dovish, gaslit sort of dynamic for these markets, supported by Jay Powell in December and subsequently since early December through a number of FOMC meetings plus fireside chats and things of that nature, where there was an expectation for rates to pivot, to roll over from 5.5 to start edging lower. And that looks like it's increasingly unlikely. So that shifted narrative for the dovish Fed to actually a more hawkish Fed, or a higher for longer Fed due to sticky inflation, or actually inflation that's coming in much more challenging. And what that does is that begins to unravel the risk on trade, which is what we've been seeing. And it allows us to focus a little bit more on a short-term risk off trade. So with that in mind, that presents some fantastic opportunities currently to start selling the US indices, to be buying the US dollar, which is what we've been doing very aggressively. 3 weeks ago, we had to put up with a pullback last week, which wasn't great. And now we've got the opportunity to stretch our legs again and to really focus on this particular narrative. And these are really high probability trades that we're talking about here. Are we getting support from higher bond yields? The answer is yes. And we can probably suggest that due to a stronger dollar, we're probably going to see weakness across the commodity markets. And are we seeing that begin to play through? The answer is also yes. So this is the narrative of focus, irrespective of what other commentators are focused their attention on. And it very well may be earnings related, which is an important factor. But these are really macro developments that do impact global finance, and it all starts with the Fed and Jerome Powell. And for us to identify, will he actually move away from this dovish Fed stance and actually say we probably need to keep rates higher for longer? And if he does, and if that message actually turns remarkably hawkish, and it depends how hawkish it will be, we can probably only expect indices to roll lower and the dollar to strengthen pretty much across the board. And that's what we're already positioned in, and we're going to continue to look for opportunities in that respect. So we're quite happy to get this this video out to you at this point in proceedings. We've had, I suppose, various bouts of really quite choppy markets over the last couple of weeks, couple of months. I would probably extend that to. So that just about concludes this short video. If you've got any questions, feel free to email us at support@thelivetrading.com, and we will get back to you as soon as we possibly can. And all that's left for me to do now is to thank you sincerely for joining us for trying to sort of explain the backdrop, the fundamentals and the technicals, and how they're all kind of aligning up quite nicely, and how they're very likely to present us with some decent high probability trades. And it's really going to hinge on literally what Jerome Powell says later on today. Can he ignore the reality and sort of still focus on this dovish Fed, which we don't think he can do anymore, but wouldn't put it past him. You know, these central bankers can get this stuff very, very badly wrong. They've proven time after time that that can be the case. However, if he does start to shift to this higher rate for longer narrative, do expect further downside from the indices with a strengthening dollar. And we'll see if we can try and exploit that as best we can. All right, guys, on that note, listen, thanks very much for joining us. We do appreciate you joining us. If you are interested in learning how to trade the financial markets, you can access one of our discounted live trading and education bundles on our website. It does start from just $59 per calendar month. Hopefully, you'll find that beneficial. We will be trading these opportunities fully live and interactive every single day. For more information, just go to thelivetraderoom.com and do feel free to connect with us through our chat box on our website if you do have any questions. On that note, thanks very much for joining us, and we look forward to seeing you next time. Bye for now.